Hey, how's it going? I'm Josh. Let's talk about dispersion trades, shall we? A really cool idea that came up in a product called FCX, Freeport McMoran this morning on my flow of ideas. I want to walk you through that. Miiflo is your flow of daily institutional investing ideas for people who don't really consider themselves active investors, but it's a different way to look at markets and also one that thinks about the risk as you are approaching it, which is so crucial. So let's jump over here and get an idea of what the idea looked like. So here are a number of ideas listed today in my flow of ideas. I took a look at Freeport McMoran and it said it's great for a double diagonal, which is a type of dispersion trade. So you likely never heard of what a dispersion trade is. So I'm going to walk you through what this is and how these work and how I put this trade on in Freeport McMoran. And maybe that gives you a new idea for how you could express an idea in a market. Okay. We're going to jump over here to a platform called Thinkorswim. And I have the combined P&L graph of this dispersion trade. Now, it's a multi-leg option strategy. So you may have heard of options and go, oh man, I don't want to deal with any options because those don't work. Well, often when people look at options, they're using like one option contract. But when you get creative with multiple contracts all at once, you can do some really, really fascinating things. So we're going to do that right now. So we got a flat grade here. We're going to go to FCX. And we're going to start about 30 days out. So this double dispersion says it's a product that's really, if we go back to the idea, we are lacking direction. We're going sideways and likely to continue. We've got earnings coming up in several weeks. So, we're kind of getting ready for a move. However, the implied volatility rank is so high, it's going to be really hard to get outside of that and make any money. So we're going to do a combination of trades to get ourselves in position for that move. And so the way to do that is to go back over here and we're going to start. So a move trade would be a straddle, but we're going to do a reverse straddle. And we're going to start by going out about 60 days. We're going to pass earnings. I just want to show you what the straddle looks like. Okay, so I'm going to buy a 30 because we're trading right around $30. I'm going to buy a 30 strike straddle. Okay, now this costs $5.68. So that's $568. So if we take a look at what that looks like in terms of buying power, that's how much it costs to put the trade on. The profit is infinite. Okay, the max loss is what I paid for it. So that's nice, but how do I monetize this trade? So we go analyze this trade and take a look at it. We can see that this is the P&L. So this is the curve today. And if I'm past 24.31 and 35.69 at expiration, I'll make money. But if I'm inside of those two prices in 60 days, I'll lose money. Because what has to happen is I have to get outside of the the place that I'm at to really make this thing work. And often options are priced to prevent that because right now they're expecting move with earnings. So I got to make this thing cheaper to give me a way to get in front of it. And the way I'm going to do that is I'm going to now sell a straddle. So I'm going to go here and I'm going to sell the 30 call and put in the October with 31 days. So we're in one that's out 59 days and then one that's 39 days. Now notice now the debit here is $1.46. So not $5.68, not $568, but $150 essentially. Okay. Now, if I go and analyze this trade, I got to get rid of the other one. Notice the P&L looks very different. Okay. So what's in play here? And I got to go to today so that this makes more sense. What's different is that I'm selling the opposite. So when a typical straddle has got a V like this is going to be the other way, and it creates this pocket for a period of time. And then the nearer term contracts are going to lose value while the longer term contracts will hold value. And it's this movement that is going to give us that pocket of profitability. In fact, you can see the max profit is close to $250 per spread. So on a $150 investment, we could potentially make $250 if we're at $30 at the expiration of that short contract, which may not be there. More likely, we're going to try to make $100 off of that. And you'll see that each day we go forward, the theoretical profit line is actually going to grow, such that before we ever even get to earnings, if we're trading between 27 and trading between 34 and 27, we can actually take this trade off for a credit and for profit. And can also put us in a position to own that long straddle post earnings at a much cheaper price if we just stick around 30 the whole time. Okay. So I've actually put this trade on in another account on a brokerage on Tastyworks. We're going to follow along and see how this goes. I got filled for $1.47 and I'm going to disperse and see how that goes. So that is a dispersion trade. A really cool way to think about markets, an idea that came from Miiflo, and those are the types of ideas that you can find every day. Miiflo.com, your flow of daily institutional class investing ideas.